Are we going to see monopolies in real estate flourish or fail in the coming years? Well, today, you get to be the judge. Wall Street could own up to 40% of the rental market by 2030, but investors are currently buying only half of the properties that they were a year ago. CoStar looks to take on Zillow's monopoly of the residential online space, but they're backing out of a deal that could have helped them drop the gavel on the portal giant's lead generation business. All of that plus, more buyers are blaming their agents, hauling them to court. Inflation remains stubborn, and Redfin and Zillow once again report major losses. Join us as we take the stand on This Week in Real Estate. Yay! What is up, everyone? Thank you for joining the show.
That might be it. Good job.
That was tough. Yeah, for those of you listening, the podcast listeners, I know you're like, wow, that was pretty smooth. No, that was a total live read, so I appreciate that. Dan writes that for me, and sometimes he intentionally trips me up, but I think those are all good.
Okay, so go back to Portal Giants. That one. That's a tough little phrase right there, and you ripped right through that. That was good.
So as I was ripping right through that, I was thinking, wow, I'm ripping right through that, because that was a difficult part of it. Let's see, but they're backing out of a deal that could help them drop the gavel in the Portal Giants lead generation business. That was the phrase there. So
that one, I expected a little bit of a stumble, but no, I don't always do it on purpose, because I do love alliteration. I do love, same letter after same letter after same letter. But they get trippy, so I try to smooth it out, but Ray killed it this week. That was good.
That was fun. Well, thanks everybody for joining us. We are broadcasting in 4 different places: YouTube, Clubhouse, LinkedIn, and Facebook. So if you're on all those things, you can comment, and then we can display your comments, just like we have some of those already jumping on. Julie Moon, she's both on Clubhouse and she's in YouTube. So she said she made it this week.
By the way, she's a huge Razorback.
Huge Razorback fan. They loved that game. Matt and Julie, I'm sure they were tuned into the Georgia Razorback game last night, because that was a lot of fun for me. So thank you guys for joining us. You could comment on any of those platforms, and then we could display your comment and talk about you, or we could reference your comment. You could also comment in Clubhouse using the chat, and you could share the chat or share the Clubhouse with everyone. Be sure you're following the Real Estate Networking Club at the top. And without further ado, let's get into the headlines. First up, we have some breaking news. Is the U.S. housing market in shambles? Home sales continue to slump for the 12th month. The U.S. housing market continues to be impacted by the COVID-19 pandemic, as existing home sales in the country fell for the 12th consecutive month in January of 2023. The National Association of Realtors reports that sales slipped 0.7% from December 2022 and are down 36.9% year over year. All regions recorded year-over-year declines. NAR Chief Economist Lawrence Yun said that home sales are bottoming out, but prices vary depending on a market's affordability, with lower-priced regions witnessing modest growth and more expensive regions experiencing declines. The median existing home price rose by 1.3% to $359,000, with 3 out of 4 regions seeing prices rise, while prices in the West fell. This marked the 131st consecutive month of year-over-year increases in prices, the longest running streak on record. However, that is really interesting. That's the longest running streak on record, 131 consecutive months of year-over-year increases in prices. However, homes are typically remaining on the market for longer, with properties remaining on the market for 33 days in January, up from 26 days in December and 19 days in January of 2022. Unsold inventories at a 2.9-month supply. Current sales pace up 1.6 months in January of 2022. Total housing inventory registered at the end of January was 980,000 units. That's actually up 2.1% from December. Let's see. And 15.3% from 1 year ago. So distressed sales represented only 1% of those sales. So Yoon said that the buyers are beginning to have better negotiating power, as homes are sitting on the market for more than 60 days can be purchased for around 10% less than the original price. I'll read that one more time. Homes that are sitting on the market for more than 60 days can be purchased for around 10% less than the original price. If I were a real estate agent, which I am, or someone in the real estate profession, I would totally copy that sentence. This is actually pulled from the article on the National Association of Realtors, so it's included in there. I would pull that sentence and say, you don't want to be on the market longer than 60 days. First-time homebuyers were responsible for 31% of sales in January, same as December, but up from 27% in 2022. So that's why we're seeing more FHA buyers have a chance. Let's see. So the housing market continues to experience declines in existing home sales. The increase in inventory and better negotiating power for buyers may indicate a slight shift in the market in the coming months.
Yeah, I see more inventory as a good thing. I see longer days on market as a good thing, especially for buyers. But Ray, what is inflation doing?
That's a great.
Inflation pushes rates up. So mortgage rates jumped this week, driven up by a record number of jobs and higher than expected inflation, says Nadia Evangelou. She's the senior economist and director of real estate research for NAR, for the National Association of Realtors. The 30-year fixed rate mortgage averaged 6.32% this last week, up from 6.12% the week before, according to Freddie Mac. Now, while mortgage rates may see temporary increases in the coming weeks, they're largely predicted to stabilize and remain below their most recent peak of 7.08%, which was set in mid-November of 2022. This is a quote from Yoon, again from Lawrence Yoon, our chief economist. Like the NAR is ours, LOL. He says mortgage rates could linger around 6.5% for a few more months before heading below 6% by summer, and maybe, Dan's going to be right, maybe even 5.5% by the end of the year. So there's a really smart man agreeing with me, the dumb man. But hey, good times. Once mortgage rates dip further, expect more home buyers to return to the housing market, Yoon predicts. But he warns that with inventory levels still stubbornly low, an influx of buyers looking to take advantage of falling rates could set off another revival of multiple bidding, which we are see from the agents we talk to around the country in their little chunks of the market. They're like, I have homes that sit for 60 days and I have homes that still get multiple offers. So it's an interesting time.
Yeah, and Dan sent me an article. Well, it wasn't really an article. It's a Yahoo Business website video that they turned into an article. I told Dan, I said, I feel like it's a fake site from what's going on there. But anyway, Barbara Corcoran also kind of echoed the same sentiment, saying that as soon as rates fall just a little bit, it's going to be an environment where prices rise again, and you're going to have multiple offers and multiple bids. We actually just this morning got a home under contract that went live. I think it was Saturday we went live with it, or Friday we went live with it, and it had multiple showings, multiple offers. We had several to choose from. We chose a great offer with a great backup offer in place, and it's in the $400,000 range. So I think we'll continue to see that thing. I think we'll continue to see those things as people get used to the rates, number one, and if the rates do drop. But, who knows? It's kind of a bit of a wait and see. There's another report we need to talk about. Zillow released their own housing report. It's the Zillow Home Value Index for January of 2023. We're going to talk about this more in the deep dive. So be sure to stay tuned to the deep dive for the end of the show. We're going to dive in. Dan's laughing at my sound effect. That's a legit sound effect for that segment. All right. So the U.S. home values fell slightly, 0.1% from December of 2022 to January of 2023, according to the report, with the typical home value at $329,542. Despite this, values remain 6.2% higher than a year ago. All right. Let me read this again. Home values fell 0.1%, but they're still 6.2% higher than a year ago. So they're falling month to month, but still a lot higher. San Francisco saw the largest drop in home values by 4.9% compared to the previous year. New listings are much lower than last year, with 17% fewer listings in January of 2023 than the previous year, and a decrease of 30% compared to 2021. Inventory also remains low, second lowest level of active listings in January on record. The typical rent in the U.S. is $1,970, which is a decrease of less than 0.1% month to month. So it's basically flat. Falling mortgage rates in January encouraged buyers to return to the market, and the monthly cost of a 30-year mortgage to buy a home priced at the national ZHVI level, that's the Zillow Home Value Index level, with a 20% down payment stood at $1,595 in January. So despite the slow start to the year, in terms of new listings, the Zillow Home Value Index shows that the U.S. housing market is still strong, with some cities experiencing high year-over-year home value appreciation, such as Miami, Jacksonville, and Hartford. The neural network-driven estimate, Zestimate, in the ZHVI provides more accurate reflection of the ups and downs of the market during periods of rapid transition. Let's put more accurate in quotes. It also suggests that the market will likely reflect higher prices in the spring and lower prices in the fall or winter. So some seasonal stuff that we can anticipate there.
Yeah, and it's also going to depend on what institutional investors are doing and what Wall Street is doing in the rental market. Wall Street has purchased hundreds of thousands of single-family homes since the Great Recession. So I think they call that 2008. A lot of times we say 2007, 2008, but 2008. So here's what that means for rental prices. Institutional investors may control 40% of the U.S. single-family rental homes by 2030, according to MetLife Investment Management. A group of Washington, D.C. lawmakers believe that Wall Street needs to back away from the market. Back away from the hamburger, Dan. You don't need another one. Sorry, that's just an introspective moment there. I apologize, guys. This is a quote from Ro Khanna. He is a Democrat representing California's 17th congressional district. And before you freak out with the California thing, there's also someone quoted from Texas, so it evens out. Ro says, what we're saying is don't have private equity buying up single-family homes. And he goes on, he's also the lead author of the Stop the Wall Street Landlords Act of 2022. And he goes on to say, what's outrageous is that your tax dollars are helping Wall Street buy up single family homes. And he said that on an interview with CNBC. Rental backing in the fall and after the 2008 financial crisis. And here's the quote from your Texas guy. This is Stephen Shao. He is an assistant professor of finance and managerial economics at the University of Texas at Dallas. He says it was that rare opportunity that attracted the institutions to build a portfolio out of these foreclosed properties. And we all remember 10, 11, 12 years ago, there was a lot of them. By 2030, the institutions may hold some 7.6 million homes, or more than 40% of all single-family rentals on the market, according to the 2022 forecast by MetLife Investment Management. In the short term, however, and we have a story on this we're going to hit real quick. In the short term, however, some companies may retreat from the real estate market as correction concerns mount. You will see some selling by us, and that's a quote from John Gray, Blackstone's chief operating officer, and he said that back in December of 2022. So it'll be interesting to watch what they do. But do you guys think it's a good thing if it's controlled by Wall Street, if the rental market is essentially controlled by Wall Street and they own 40% of the market?
I mean, so we'll dive into more of this in the deep dive.
Yep, there it is.
At the end of the show, we got this other article that I'm about to read. Plus that we'll kind of talk more about it. But I don't know. I'd love to hear you guys' opinions. Drop it in the comments. Put it in the Clubhouse comments. Drop all the comments. Is it okay? Let me ask it that way. Is it okay for institutional investors to buy up a whole bunch of the residential housing market and hold it for rentals? Or is this bad? Is this damaging? I should have tagged
hold it for ransom, more like Ray.
That's a bad joke. It's a Dan joke.
Yeah.
All right, but investors may not continue to purchase. There's some major shifts that are happening. This report comes to us from Redfin. It says investor home purchases plunge by a record 46% amid fears of substantial home price declines. Investor home purchases have fallen by 46% year over year in the fourth quarter of 2022, according to a report by, I think this is Redfin, maybe it's Zillow. The report shows that investors purchased only 18% of homes sold, down from 19% a year earlier. The decline is attributed to the high cost of borrowing money and the prospect of substantial home price declines that have made real estate investing less attractive. The Pandy boom towns, Las Vegas, Phoenix, saw the biggest drop in investor purchases, falling over 60% more than any other metros analyzed. Investors pulled back. Now the phrasing of that, it's fallen over 60%. That's more than any other metros. It's not 60% more than the other metros. It's 60%, period, more than any other metros.
Is more than, right?
Yeah. Investors pulled back from single-family homes more than condos and townhomes, and high-priced properties more than low-priced properties. The decline in investor purchases is the second biggest in recorded history, with the biggest decline occurring in 2008 during the subprime mortgage crisis. The investor purchases slumped 45.1%. While investors pulled back on home buying, individual home buyers also pulled back, keeping their investor market share fairly steady. So whenever they're analyzing the share, if regular home buyers also pull back, then that's going to make investors also look like it's a steady pullback too. So investors purchased 17.8% of all homes that were bought in the metros, tracked by Redfin in the fourth quarter, which is comparable with 17.6% in the prior quarter and down 19.4% from a year earlier. Let's see. The decline in investor purchases is attributed to the prospect of home price declines, which has prompted investors to back off. While it's possible that investors will start to wade back into the market this year, given that mortgage rates have ticked down from their 2022 high, it's unlikely that investors will turn with the same vigor they had in 2021. This is good news for individual buyers who are still grappling with high housing costs and affordability. Investor purchases in the fourth quarter of 2021 were near their record high. All right, so although we're talking about institutional investors, and again, we're going to be talking about this more in the deep dive, but although we're talking about institutional investors and exactly what's happening with them owning more and more property, it does look like those same investors are pulling back. So we'll discuss this more in the meantime. But Dan, speaking of big time investments, a good friend of ours is offloading one of the biggest ones.
Yeah. And before I hit it, I want to say, keep those comments coming, because these quick hits we're going through real quick. We're not going to hit all the comments, but we will come back to them when we hit the deep dive. We'll circle back to these. So keep them coming, please. It keeps our engagement up. We really, really appreciate it. So keep those coming. But what in the world has Gary Keller done now? Keller Williams offloads their mortgage division to Mutual of Omaha. And my first response was, Mutual of Omaha, that's a thing. I didn't know that was still a thing. I thought that was a thing in the 70s and 80s when I was a kid. I was like, what? That's a thing? And they're buying a big chunk of Keller Williams? That's weird. But Mutual of Omaha Mortgage has acquired Keller Mortgage for an undisclosed amount. It was announced Monday during Keller Williams' annual family reunion, where Gary Keller likes to get everyone together and play guitar. That's literally the only reason he does that. With the deal, Keller Mortgage will become a Mutual of Omaha Mortgage subsidiary, and operate alongside MOMS. Get it? Mutual of Omaha Mortgage. Operate alongside MOMS' existing forward and reverse mortgage divisions. Now, this is where it kind of stays interesting to me, because it's like, all right, they tried a thing, it didn't really work. But Keller Williams will retain an undisclosed ownership stake in Keller Mortgage, a KW spokesperson confirmed. Why? Why are they still maintaining? Why aren't they just selling and moving on? Or do they need the support to keep it going? That's kind of what I thought.
That's interesting.
So this is a quote from the guitar player himself, the guitar in chief, we'll call him, the GIO, Gary Keller.
Wait, does he play lead guitar?
Yeah. Oh yeah. He does it all.
I thought he did bass. Doesn't he do bass?
No, he plays guitar, and then halfway through, he flips it up, and his mustache does it. It's awesome.
Oh yeah, that's right. Okay.
Yeah.
All right.
That dude is holding on to the mustache. He's been through like 6 different phases of mustaches are cool. No, they're not. Mustaches are cool. No, they're not. Yeah. He stayed consistent though, but I digress. He says, we're excited to announce how our 2 leading brands, Mutual of Omaha, a leading brand, leading brands are coming together. And he goes on to say, RKW customers will have access to even more comprehensive slate of mortgage services from a trusted brand with more than a century, literally ancient, century of business experience. It's truly a win-win for all involved. So that's going to be something interesting to watch. I don't know if that's a win-win, but I am a little curious as to why they're keeping a stake in it.
What access does an agent at Keller Williams have to the services and goods at Mutual of Omaha that no other agent would have?
If I just went up to Mutual of Omaha and said, hey, can I have access
the same
to
deal
these services? They'd be like, yeah, you're good, of course.
If I have a buyer, when they get the same deal, I don't understand what is. I think this is placating, like, hey, we have a failed mortgage business, we offloaded it.
Right. It's the mustachioed man way of spinning it into a positive for his company. That's really it. Because they tried a thing, which you got to give them props for, but it's obviously a large L.
As horizontal integration, it was all the rage, and it's something that we talked about ad nauseum on the show as everyone was doing horizontal integration. I mean, even our company does the horizontal integration. Everyone's doing it. It's not necessarily the land of milk and honey that everyone thought, because with those other companies, there's tons of expenses, and if you don't have the expertise or the people delivering the leads, then it's not going to be successful no matter who you are. But speaking of not getting the leads and not being successful, let's talk about Zillow. So Zillow profits plummet in Q4. Is the real estate giant on the brink of collapse?
I mean, it's like 5 years in a row.
Yeah. So Zillow dropped its earnings report for Q4 of 2022, and we've got all of this for you. It made $435 million in revenue, which is only down 19% from last year. So they made $435 million in revenue, only down 19% from last year, but they managed to reduce their losses from $261 million to $72 million. Progress is progress.
Yeah, I guess.
So they only lost $72 million off of a $435 million revenue. Again, my team is more profitable than Zillow. So however you value Zillow, just take that into consideration.
By myself, I'm more profitable.
In total, Zillow generated about $2 billion in revenue for the entire year, which is an 8% decline from its previous year. However, their net losses for the year went from $528 million only down to $101 million. So they have a net loss shavings of nearly, what is that? It's over 75%. It's like 80% shavings of their net loss, something like that, maybe.
There you go.
So things are looking up. Zillow CEO Rich Burton is pretty stoked about the results, saying, "We outperformed our expectations, building momentum that will help us scale as we serve customers in the industry with easier, more seamless way to transact in real estate." Again, we talk about efficiency. Whenever CEOs lay off a bunch of people, it's easier, more seamless, more efficient. Speaking of which, Zillow's housing super app is still a top priority for the company. If you haven't heard, it's basically an app that integrates all aspects of the real estate transaction in one quote unquote seamless experience. Despite the challenging year, Zillow's shares were trading around $47 on the day of its earnings report, up for one day compared to the previous 6 months. All right, so what do you think? Is Zillow in trouble? Are they just minimizing operations? Are they more focused on agents? Are they still trying to take over agents? What's your quick hit, Dan?
My quick hit, to me, they're kind of retracting into their shell a little bit because they did take such a big hit in the iBuyer market. That's kind of my thought on it. That they're kind of doing what they have to stay alive right now, because they're always going to continue to get traffic to their website, and they're always going to pull money from ad revenue. And then apparently they're always going to pull money from, agents buying leads. But I do have one question, Ray, and we're about to move on to the next story. Will the Zillow killer known as CoStar be able to take them down?
I've always hoped.
So CoStar will not acquire realtor.com portal after all. Now, I believe we covered this, Ray, in January, I think is when this came up.
Yeah, we talked about them being in talks.
Yeah, and we were pretty excited about it, because to kind of pull that away from their own, it'll talk about who they're owned by. They're owned, realtor.com is owned by News Corp, is owned by Move Inc., who is owned by News Corp, which just sounds like an evil villain company to me. Conglomero, it just sounds like a big dumb animated villain to me. But anyway, CoStar
Movato. Isn't that
Yeah,
the villain on Zoolander, or is that an actual company?
I think Movato is an actual company you're thinking
Oh,
of. Anyway, it'll pop into my head later. But anyway, CoStar CEO Andy Florence made the surprise announcement about Realtor.com during an earnings call with investors Tuesday. Florence expressed respect for Realtor.com. Good on you. Good on you, mate. And the parent company Move Inc., which is owned by News Corp, but said that at this point, CoStar will instead focus on its homes.com business, which I forgot they had. He says, at this point, CoStar is not acquiring Realtor.com. And he added that we continue to believe that the homes.com business model and principles are well aligned with SIC, National Association of Realtors members, and real estate agents generally. And remember, he's kind of a fan of agents. He's kind of what Zillow said they used to be. He's kind of got our backs going after Zillow. That's why I call CoStar the Zillow Slayer. News of CoStar potentially acquiring Realtor.com first surfaced in January. The possible deal made waves because CoStar has openly criticized Zillow and indicated a desire to offer a competing portal business. Among other things, Florence has suggested Zillow's business strategy amounts to blackmail, his words. His word, I guess that's one word, said that the strategy amounts to blackmail against real estate agents. Florence's willingness to criticize Zillow has earned the company some fans within the agent community who are dissatisfied with the portal giant's lead generation business. And that's probably because we don't feel supported by our own,
association.
We don't feel supported by our own association. So we have this dude who is another, billionaire guy. And he's like, no, screw them. They suck. And we're like, yes, bring your commercial success over to real estate or to residential, please. But so we'll just have to kind of watch, hopefully NAR steps up and does the right thing, but we keep asking that and don't receive what we request. And
hang on, I have a quote. I have a quote from National Association of Realtors. Let me bring this up for you.
We do not care.
Yeah.
Okay, there it was. All right.
Yeah, and then we'll see. We'll have to watch what they do with homes.com.
Yeah. Well, Redfin, they also released their earnings report, and it wasn't pretty. To quote, it's a hot mess. Let's talk about Redfin's earnings report. It's not great news. Redfin, the online real estate brokerage, announced that its revenue fell by 25% compared to the same period last year, bringing in $479.7 million. To make things worse, the company lost a total of $61 million during the same quarter. That's up from $27 million in 2021. CEO Glenn Kelman said that the company spent the fourth quarter improving its sales force and shifting more digital margin revenue, among other things. Here's the silver lining. Kelman believes that Redfin will be profitable by 2024. I don't think they've been in the black yet, have they?
No, not once.
No. So we're maybe there was one quarter, I think, that they were in the black. He said that the company's discipline to make adjusted EBITDA this year can make it very profitable. In 2022, Redfin brought in about $2.3 billion in revenue. However, the company's total loss for the year ended in $321 million, which is a significant spike from the previous year's $109 million. Redfin shares fell. Redfin's latest earnings report shows that the real estate market is toughening and the company is feeling the impact, but with its focus on digital margin, revenue, and improving sales force, Redfin's positioned itself to make a comeback, they hope. So yeah, Redfin not doing so hot. Zillow not doing so hot. You mentioned CoStar earlier. What are they? Are they doing hot?
So despite a slow market, CoStar sees revenue and profit rise. So a lot of times we read these articles and it's like, dude, we made a lot of money. But then you read the actual numbers, you're like, well, our profit was like negative. I mean, we lost like $200 million, but we made a lot of money though, but we lost like $500 million, but we made a lot. But despite a slowing real estate market last year and amid an ongoing feud with arch rival Zillow, CoStar on Tuesday revealed that both its revenue and profits jumped in the fourth quarter of 2022. Now some quick numbers, and then we can move towards the deep dive. So in total, CoStar brought in $573 million in revenue between October and December, according to a newly published earnings report. That's a 13% increase compared to the same period in 2021. So this is where I kept reading, and I'm like, okay, let's see what the actual profit was, because it's going to be a loss. But no, profit also jumped, rising 30% year over year to a 124 million. That's a pretty good jump. Tuesday's report additionally shows that for all of 2022, CoStar brought in 2.18 billion in revenue and a 12% year over year increase, and made 369 million in profit, a 26% increase. Immediately after the company published, I just thought this last part was interesting, and then we're going to move on. But immediately after the company published its fourth quarter earnings, however, shares plummeted in after hours trading from $76 to about 63. I thought that was really weird. Maybe it was because of the Realtor.com announcement, but
yeah. So I think
maybe, but who is really that sensitive going, oh, I thought they were going to buy Realtor.com.
I think the whole reason why their stock started to go up earlier in this year is because they were announcing the acquisition of Realtor.com. So people wanted to get in, and then when it was bought, the stock was slated to jump up a little bit.
Yeah.
But there were some inside the company that said that it was never going to happen, that it was used for posturing. And now I'm wondering if the posturing was to have a more significant increase in their stock price ahead of their earnings
report and get their shares up.
Yeah. So I don't really like the move. I don't like the corporate move. I don't like that it was a move that just kind of played the market, because whenever that happens, it shows some market manipulation, in my opinion. So I'm not a huge fan of that. I do like CoStar as a company because I do feel like they're more apt to back an agent versus a Zillow or even a Redfin. But
you're right, though. It's a little bit of a rug pull, kind of like what influencers do with Bitcoin. A little bit of a rug pull there.
It remains to be seen. Speaking of millennials and Bitcoin, there's some new investment opportunities that they've been taking the advantage of, and this was sent to us by a contributor. So when an abandoned high school in Homestead, Pennsylvania was listed for sale in 2019, Jesse Wigg saw the opportunity. The sellers were asking $100,000. The 34-year-old real estate agent bought the school and then reached out to a friend who connected him to a guy. And basically, for 2 years, they went back and forth on what to do with the structure and finally decided to turn it into like a giant residential complex. The two realized they needed help and connected with Dan Spavik, a 41-year-old full-time developer, former high school. Oops, I lost my place there. Former high school classroom became new modern apartments with in-unit washer and dryers, and the auditorium turned into a shared space. They also added a full gym with half basketball courts, weights, Peloton bikes on the ground floor. The partners received historic tax credits from the federal level and from Pennsylvania. They wouldn't disclose that amount, but that's smart. After purchasing the school in May of 2019, construction on the building started at the beginning of 2020, right as the Pandy was starting, and wrapped up in October 2021. So the finished product, and this was, I think I mentioned this was sent by a contributor, Howard Harold Broadsley. He sent this to us. The finished product boasts 27 one-bedroom apartments, 4 two-bedroom apartments. Yeah, both. There you go, say worders. The partners also added solar panels to the rooftop to help with their environmental footprint. Leasing started October of 2021, just 6 months after the building reached 100%. Just after 6 months, the building reached 100% occupancy. That's pretty rad. They rent the building $1,400 a month for 1 bedroom, $1,650 for a 2 bedroom. They share expenses based on proportional share of the building. They're already ready to take on some other projects. So I thought this was really interesting because we've been talking on our show about people using malls and kind of abandoned commercial space and abandoned buildings to help with the residential inventory. This is a much more interesting build to suit situation than I've ever heard. So using a school, then turning the school into residential apartments.
Well, and I'd be curious to know, because it is a high school. So usually high schools have football fields, baseball fields, softball fields, soccer fields. Like, is there land around this? Did they do anything with the land, or was that sold separately?
Oh, that's a good idea. I don't know. I mean, when you acquire, there's so much. Yeah, you usually have like a complex and a basketball court and all that stuff, right? Or a football field. I mean, they have a half basketball court they added in there.
Yeah, the high school I coach, I mean, we have a ton of land. It's very, very well used. There's a lot. There's 4,000 kids at this school, but it's really well used. I'd be curious to know what they did with all that land, or if it was sold separately and going to be turned into something else. But I can also imagine the location is pretty cool. It's just,
probably urban.
Yeah, probably urban, some residential around it, homes, single families, and then you got this cool, unique thing. I think that's a great idea. I love that. Good job, Millennials.
Good job, Millennials. And that's the end of the headlines. That's one of my, that song alone takes me back to many days in front of the Nintendo, Super Nintendo.
Oh, yeah.
All right, so let's open up for discussion. The first thing we're going to talk about in the much maligned deep dive. We're going to talk about this housing market showing signs of life and inventory according to the Zillow report and really what's happening. But I want to get to some of your comments here too. Jack Adridge, he is commenting on the YouTubes. He said, is the market slow because of lack of supply or lack of demand? It's the latter here. Many sellers won't give up 2 to 3%.
See, now I would say it's the latter as well. Same thing here. There's just, there's over 200,000 agents in California. And I think last month in December, the last time I looked at the report, there were about 19,000 closed transactions. So I don't know if you want to do some math on that, but that's about 180,000 transactions short to give every agent one transaction.
Yeah.
Here in California.
Mike V says, don't expect a significant drop in rates until after the summer. I think that's also what most economists are saying too, that they expect a drop in rates. But I've been watching the news a lot lately, because whenever the CPI index came out last week that we talked about, it was just a little bit higher than what most people thought. That sent signals that the Fed would probably either keep rates higher longer or even do another rate increase of like 0.5 or something like that. So I think there's a lot of fear in the market that rates are going to continue to go up. All right. Is there anything else? Well, Dan, before we get into this deep dive segment, would you take just a second and tell people what this show is actually all about?
I'd love to. Now, when Ray and I started this show, I had an idea when we met back on the interwebs back in 1983, I think it was, back in the Oregon Trail days. We met on the interwebs trolling real estate agents like Gary Keller and his glorious mustache. But again, I had an idea for a show, and back then we called it the Bearded Men of Real Estate, because we are in fact Bearded Men of Real Estate, and we've changed it to This Week in Real Estate. But when I met Ray, I noticed something very interesting about him.
What was that, Daniel?
He's never, not once, dipped even one little tiny toe in the Atlantic Ocean. Not once.
Let's see. Which side is the Atlantic on? That's
Coast.
that one. No, I haven't actually. You're exactly right, Dan. I've never been to that coast. I've always been Gulf or Pacific. So
yeah, he's been here. I've met him a couple times, but I don't even know if you've dipped your toe in the Pacific Ocean, which is my ocean.
Yes, I did. I've been to Coney Island. I jumped in the Wawa.
No. Pacific is me, West Coast.
And Coney is. What's the little place in California? The dock that goes out.
Catalina Island.
Yeah.
There you go. So that's Pacific Coast. Yes. So I knew that, and I thought maybe you'd been in the water here. So I went with the cheese toast, but I thought you'd been to North or South Carolina. You'd never been there?
I have, but it was cold. Went to the Highland. My aunt used to live in the Highlands of North Carolina. It's up in the mountains. It's not near the
coastal.
No.
So anyway, that's a little tidbit around Ray. I always try to get him on something. Usually he's like, actually, Dan.
Actually, yeah. Oh yeah, I've been to the beaches of Florida beaches a lot. One of the best beaches back in the day was Minnesota Beach, not Minnesota, Minnesota Beach.
Minnesota.
That's how it's pronounced. And they had tons and tons of shells, so we would always go down there because my parents liked the shells. With tons. I
love that.
Shark's teeth.
But I digress. So I obviously noticed that he's a beautifully bearded man, but I also noticed that he loves giving value up front to not only his clients, but just to agents in general. Just to humans in general. So the show's about being more as an agent, but also being more as a human.
And one of the ways we believe in being more is to know what in the world is going on so that you can advise your clients, or if you're an investor or a lender or a title company, that you know what's going on in the real estate so you can operate better in the real estate market. So that's why we do this. And now I really want to jump in to some of these headlines and have a deeper dive. But before I do, I also want to confess that I went viral. Did I tell you this?
Oh,
I went viral.
So did I. I did too.
You did? What did you go viral on?
Just a dumb reel I did on Instagram. I got over 1,000 likes.
Wow, that's a lot of likes. What are your views on that thing?
That's a lot of likes. The views are only at over 4,000, but that's a lot of likes because I know why they liked it, because I remixed with a pretty girl riding a horse. So they went, oh yeah,
that one. Yeah.
But they didn't watch the whole thing, because then my dumb face comes in 8 seconds later.
You're super clever in how you're doing all that.
Yeah, but 1,000 likes on that one. So that is viral, especially I have 900 followers on Instagram. There you go. Boom, viral. How'd you go viral, buddy?
I had a throwaway comment on the tweet.
On the twits. Yeah, dude.
Yeah.
This is amazing. This is big.
I should show people what it is.
His went big.
It's got over 1 million views now.
Yeah.
It's ridiculous. So there was this video.
It's so ridiculous, Ray.
And what's funnier is I had to tell people, like, this is a joke.
Right. Like we love the long-term trolls, but this one he had to be like, you guys understand, right? Like, this is
all right.
Yeah.
So here's the video. Did y'all hear that? Oh, you don't see it yet.
No.
All right, hang on.
There you go.
Okay, so here it is. I'm going to zoom in to this top part here. And basically it says NASA confirms a meteor that's a half ton crashed in South Texas. So South Texas friends, I'd love to see your Ring doorbells. It's here. Listen, that was it. That was a meteor hitting, and they're showing a picture of somebody's like Ring doorbell or something like that, like a little
rough camera
video out in front of their house, and it's showing like a chicken in the yard, and they kind of run and birds fly whenever the boom happens. And my comment was, NASA has cameras all over the universe, and this is a shot of the meteor hitting the home planet. NASA, do you have another angle? It's been seen 1.1 million times.
So good.
And there's so many people that would be like, NASA doesn't have cameras all over the universe, bud.
He has 12,000 likes on this.
It's a lot of likes. And it's just so weird that you go viral from something that's so stupid.
Yeah, they don't have cameras. But the biggest thing, Ray, was
cameras everywhere.
People, they don't have cameras everywhere.
So I put the definition of satire, comments to my own comment. So I put satire, the use of humor, irony, exaggeration, or ridicule to expose, criticize people's stupidity. Put that on there.
That's so good.
And then I find how I used it was
i.e.
humorously juxtaposing the poor quality of a cheap doorbell camera, capturing a space event on Earth with an exaggerated capability of NASA, and featuring a commentary on the hopelessness of man despite our best technologies and brightest sun on the job.
I love that. And Jack Attridge with my next
Great point.
YouTube video. Meteors are destroying the housing market.
One boom at a time. Good. All right. Speaking of destroying the housing market, I want to take a look at this Zillow, this full Zillow report in our deep dive. It says, I'm going to share the screen too. It says, here we go. I'd love you guys to chime in on this as well. It says housing market showed signs of life in January as buyer begins to compete still scarce over still scarce listings. Sorry, my eyes didn't see the word over. I was like, why isn't that a complete? Okay, so the typical home value fell slightly. We've already talked about this in the headlines, but I'll just kind of review the session. Typical home value fell slightly December, 0.1%, but they're still 6.2% higher than a year ago. Home values were lower than last January. Newly pending listings were similar to 2020 levels, or down 20% year over year. Median time on the market was 31 days, which is slower than 2 years ago. There are 70 fewer listings, new listings than last January, fewer than January 2021. Inventory remains low, second lowest level on record. All right. So here's some graphs that they had in the report that I wanted to highlight there. The Zillow Home Value Index raw from January of 2023. And you can see the growth from January 2004 to January 2014, month over month growth. And then you can break it down by area.
I love when graphs are.
Oh, no, it goes all the way. It goes all the way. But their words don't. Let's minimize their. This is a interf that is clearly messed up.
It's just interact. It's not interactive.
It's not working.
Yeah.
All right. So you could basically back it up and say, okay, well, what's it look like in a closer index period here? But this is not working very well. Anyway, we'll just go to the next one. Newly pending listings. You see the data from January of 2018 all the way back down. We're still lower than January of 2018. We kind of made this. It's like a lazy arch is the trend line there.
Yeah, looks like a little bit of a Marvel bad guy from a different universe.
So, and they asked will sellers return? And if they do, what mortgage rates will buyers be facing? That's what I want to discuss. Will sellers, or they do, what mortgage rates are they going to be facing here?
And we have I'll answer that. And we have some comments on Clubhouse as well. So if you guys are on Clubhouse, you can comment. I know Julie Moon doesn't know how to work Clubhouse anymore because her boomer eyes are just not working, I guess. But you can't comment on there. Sorry, Julie, I love you. But let's see. So what was the specific question, Ray? Because I got distracted because now I'm reading this.
The big question is this: will sellers return? And if they do, what mortgage rates are they facing?
So I think they're going to return because of the interest rates. Does that make sense? So I think interest rates will excuse me. I think interest rates will be the catalyst. So there will be more buyers in the pool when they settle around the mid to high fives. More buyers are going to jump in the pool, and I think sellers are going to go. And this is going to be around summer too. I think the timing is going to work out perfectly. Sellers are going to go, well, you know, interest rates have settled. They've kind of been in this 5 to 6 range for a while. Buyers are going to buy my house now. They're still seeing multiple, or, you know, not crazy days on market. They're still seeing multiple offers. So I'm going to predict a little prediction here. I'm going to say that interest rates are going to be the catalyst for more sellers to jump in.
So but a seller that's sitting there at a 2 or 3% rate, I mean, they have to see another opportunity beside the rate. I think the rate may move them because they're going to say, well, it's not so bad anymore. So
yeah, and remember, they also may be purchasing as well. And if they didn't sell during the hottest times where interest rates were in the 2s and 3s, then they can still get a low interest rate. Again, when they dip down in the 5.5 range, they can still get a pretty good rate to lock in and still maximize. Because what did you say, Ray, in an earlier stat? You said values are down, but they're still up 6.3% from a year ago, which is up
month to month it went down. The report says, Zillow says month to month it went down 0.1%, but it's still 6.2% higher than a year ago.
And it might be a little better market for them because right now, if you're selling with so many buyers jumping in, you're going to have to give some concessions. So maybe the market will even out a little bit to where it's, I don't know. I've never seen an even market in my 13-year career. So
like a normal market.
Never seen anything normal. So, but I would say that I think
California though. That's why you've never seen anything normal.
There's nothing normal about us Californians anyway.
That's right. Let's see. But Mike says we'll be in the mid 7s in the next 2 months.
Interesting.
You're not the first person to say that. I've heard other people say that due to that CPI, they're going to raise those rates again. And if they go 0.75, then it's going to like do a super surprise to the market, and those rates are going to go through the roof. But
they're going to try to curb the inflation still, right?
Yeah, they have to do something. Mike said he called the highest rate during the prediction show. Yeah, it behooves of Mike.
Yeah.
So he can win. I mean, that's really what it's all about. Is winning the prediction show. He predicted a 6.875. You have a good memory. I don't even remember.
And he is a lender, by the way. So Cindy on the Clubhouse, and I don't know if I'm saying her last night, if it's Urona, like you skip the I, if it's Uriona, because there's an I in there. He was a lender, my bad. Cindy says, so such a crazy market, mixed bag in Utah. Our sales are down 49%. One listing getting multiple offers. One listing is 30 days and not even one showing. Shocking. Both equally nice and priced properties. I'm assuming priced well properties. So that's interesting. Kind of similar to what Dusty's seeing in Arizona. She's like, some houses are way overpriced and they're just going to sit there for 60, 90 days, whatever. But then you have other ones that are priced well and they go fairly quickly with 4 to 8 offers.
That is interesting.
Yeah, Cindy says it makes no sense. Olivier, been like this here too. Cindy, entry level is okay. Remember, Olivier's in Canada, I think in the Toronto area, I believe. The rest is hard. We are on pace for 33% less transactions in the first quarter. Yeah. So there you go. Some more on Clubhouse, but you have comments, you can comment there or on YouTube, Facebook, whatever. We prefer YouTube because it keeps our engagement.
Jack Atteridge says Trump rates. Yeah, I agree. People got to move because the job's moving them, or they got to move because they've had too many kids. They got to move because they have too few kids.
Well, and that's kind of why I'm lining that up. I know Mike's saying, it's going to raise over the next couple months, but I'm seeing them settle. It might be after summer towards the end of the year, but if that perfect storm hits and they're settled in the mid to high fives in summer, I think we could see a little bit of a boom. But there's a catch-22 with that, because if not enough listings do come on the market and new construction doesn't catch up, well, we're going to see those artificially inflated prices keep going.
Yeah, I agree. If new construction doesn't catch up, it's definitely going to mustard.
Yeah. There it is.
All right. So next up on the deep dive slate, let's talk about this institutional investor thing, because I think that's a big deal. So this article is on Redfin. It says investors are buying half as many homes as they were a year ago. It does say in the headline, roughly half.
So that could be 2% less. That could be 60% less. Roughly, just
roughly half.
Rough estimate.
46%. 46% year over year. Yeah, that's how far it's down. Again, they have a good chart. I'll share the screen here so you guys can see that.
We love our
investor home purchases fell most on record, and so you see how high they were. I mean, they were really high, and then they bottomed out. This is the this goes back to 2002. Yeah, this is the year over year change in the number of U.S. homes by investors. So it shows a massive. I wish this one was interactive, because I don't know what date that high was, but probably 2021, based on where it is on the chart.
Jeez.
Who declared a pandemic, and then it plummeted for 2 months, 3 months, and then went, or 3 quarters, and then went way up, rocketed.
Yeah, and then Empire State Building down.
yeah. Basically, it looks like an Empire State Building on the way down for the audio listeners.
Yeah.
They slumped 27% on a quarter by quarter basis, the largest quarterly decline on record. Are you working with a lot of investors? I am working with investors, and they're just, if I had the homes to sell them, I could sell 100 homes this month. They are that's how much they're trying to acquire. We have several investors. Are yours
institutional though? Are they that?
I mean, what makes them institutional?
I think they're the mass buyers that buy portfolios, that buy 1,000 at a time, that kind of stuff.
According to Joseph P. Biden, the institutional investor is one who buys more than 10 a year. So all of these would be institutional because they're buying more than 10. They'd buy 10 this week if I could find them.
Yeah, see, that goes into I don't think that's it at all, because that goes into the territory of what Dusty was saying is, if she could do this and she was a quote unquote big fish in a little pond, she would do this, but she's a little guy. But if she's buying 10, and I know it's different businesses, but I'm just saying for the little guy, if they're buying 10 properties, that's still, 10 properties is relatively small.
I guess, yeah.
Compared to what these institutional investors, because pretty much anyone.
This is Dusty's comment over our faces.
Yeah.
She said, as we discussed last night, I'm torn. She's discussing in our contributor chat, by the way, guys.
Yeah.
If you want to join that, let us know. As we discussed last night, I'm torn. If I were the rich investor, I'd do it. But it also irks me as the little guy. So she's talking about them buying up, the institutional investors buying up a whole bunch of residential properties and holding them for rent.
Yeah. Well, and remember what I said in that article that I read about investors possibly owning 40% of the market by 2030. That was kickstarted by, a bailout essentially, and to get them going, to kind of kickstart the market. And they were like, sure, we'll use your money. We'll use taxpayer money to buy all these properties. Why not? And then we'll keep them and charge them really, really high rents, and we'll keep rents artificially inflated. Why not?
So would it help? Is it okay for investors to buy and hold all these residential properties, in your opinion?
No, absolutely not. If you go back to, I already kind of touched on it, but Jack Attridge had a comment, and he said, if if essentially if they keep buying, it's, a lot of people want the American dream, but with all these big investors buying up more properties, it really kills that dream and keeps it extra competitive for them. So this little reprieve we've had over the last couple months or the last year with investors purchasing less properties, that opens it up for the American dream for the average quote unquote American home buyer.
Yeah. I mean, I'm also torn because a lot of these investors are not big time players. They're not institutional investors. So what we're seeing a lot of is that people start these groups, and they have groups of regular people that want real estate to be a part of their investment portfolio. And as a group, they buy 500-600 homes, and those institutional investors hold them. But those are normal people that are getting paid on that.
Yeah, but what about generational wealth though? Can they create generational wealth that way?
I sure hope so. That's what I want to do. I don't have a problem with it. I think what it should do is feed the economy. I'm a big believer in capitalism. So as long as people are acting in their own self-interest, it should help in capitalism because more and more people would then provide the services. The problem we have is that the forces outside of capitalism, the tariffs on the taxes and stuff on stuff that's coming from out of the country. There's supply issues from COVID. There's, the government creating an inflationary environment through spending more than they should through the pandy. So there's all these other issues that are not really capitalistic forces that I think are harmful and make it almost impossible for the little guy to get a foot up, while the institutional investors and people like that are still going to be doing this and moving. I don't think there's any way to stop it. Jack Adridge says,
and then Cindy's,
too many people searching for the American dream, and investors limit the dream or push it out of reach for those rising prices. Well, one of the things I always note for my clients is that whenever we have a consultation, I sit with them and I discuss, what type of buyer are you? And it kind of throws them like, what do you mean? What type of buyer am I? And I say, are you an investor? Are you an owner-occupant investor? Or are you someone that wants to buy a home to live in over the next 5 and 10 years? They're like, well, yeah, we want to buy a home and live in the next 5 or 10 years. Like, okay, well, if you're that, then you're going to be more specific about what you care about on a property. And so is everyone else that's competing with you in the market. So the price you're going to pay is at or above market value. Like, well, I want a good deal. Like, well, are you an owner-occupant investor? You're looking for something that you can put some legwork into and flip, and you don't really care if it has green shag carpet or if the window doesn't face out from towards the backyard from the kitchen. Or if you care about that, then you're going to have to be more choosy. And the more choosy you are, the higher price you're going to pay. The way the institutional investors are making a ton of money is they're buying whatever as long as the numbers work. They don't care which way the house faces or if the yard was overgrown or not when they purchased it. It's just a figure on the spreadsheet. Just numbers. Yeah. So, they acquire way more properties than the average person because they're less choosy about the things that the average person's more choosy about. It's just logical. So I think the growth in them is evidence that real estate is a wonderful investment that more people should be buying because they're not making any more of it.
But are there enough properties for everyone?
The only place they're making more land is in Dubai.
Literally producing it. Cindy on Clubhouse says, have you seen all the apartment building starts? Way more than housing starts.
Yeah, multifamily and apartments, I think, is where a lot of these investors are going to be playing a lot.
Yeah.
I would agree with that. All right, let's see. No more comments on that specifically. We have some comments about the NAR story, which was good. Everyone wants them to take control of realtor.com. Yeah. Olivier says most of these real estate companies, talking about Zillow, Redfin, they are not making money.
CoStar is. Maybe we switch over. We're now CoStar Association of Realtors. We're Core. And then listen, and then people who don't want to be full core, they can be Core's Light.
Dusty Martin on the investor topic says, I'm just jealous, but I also like money. Let's be honest. And then she agrees with me. She also says that China is building islands in the Pacific. I know there's a lot of land being created in the ocean, which is interesting. Okay, so I guess let's talk about the next article for our deep dive here. And this is one that we haven't talked yet that I really want your opinion, especially if you're a real estate agent. What's up, Melanie? She's down in the chat. What's up?
Hey.
More home buyers are blaming their agents and hauling them to court. So this is on Inman. The freewheeling era of waived inspections may be coming home to roost as a growing number of homes pointing the finger at their real estate agents in court. So here's what I want to know. I'm going to ask this question off the top.
Okay.
Are the real estate agents responsible or are they not responsible? Can they be sued, and is it a legit suit?
So here in California, our contract specifically states there's a buyer's inspection waiver, a buyer's inspection advisory, a BIA. You have to you read that, you have to sign that. It's part of the contract. It's a separate contract, but it becomes part of the however many pages we're at now on the purchase agreement.
Well, and apparently real agents have been sued in the past. So because this is talking about lawsuits before this. So this is not new that real estate agents get sued, but there's a higher percentage of.
Well, remember why? When the market was hot in 2020 and 2021 and a little bit into 2022, people were saying, I'm waiving everything. I don't want an inspection. I don't want an appraisal.
Yeah.
I'm all cash and I can close in 4 days. So, we probably mentioned on the show, this stuff is going to come back to bite, but specifically here, we have a very long residential purchase agreement here in California. And it's because, there's redundancies all over this place as far as how agency works. There's technically multiple contracts you have to sign multiple times. There's a paragraph in the RPA, and then there's an actual contract. And then on top of that, I get an actual, it's called a buyer broker agreement, where they work together. They acknowledge that, we are working together and that they are going to work with me to buy this property. And it's a buyer's inspection waiver. You have to waive it. If you're waiving it, you have to check it off and say, nope, I'm waiving it. I do not want one. So essentially,
interesting,
that relieves the agent of all culpability. So I don't know how they could sue here in California unless they didn't sign that, or
anyone with an FHA loan supposedly receives the for your protection, get a home inspection pamphlet, right? That's a federal rule. So if there's a lot of agents that did not get that and didn't get their clients to sign off on it, that could be an issue. Or has text where the agent says, well, everyone's waiving inspection. If you want to get this deal done, you better do that too.
That's where it could get slippery. But Dusty, we don't have disclosures to show a house. We just show houses.
Yeah, Dusty Martin says you guys also have disclosures out the wazoo.
Just to show a house.
Well, there's some that are you have to sign off your life if it's an investment property. Some of these investment properties may have mold and stuff.
No, when you get up to a certain property value in the 2, 3, 4, 5 million, they want to see your bank account to make sure you're not just a looky-loo going through the house. But no, we just show houses. We don't have disclosures.
So these lawsuits have become even higher stakes ordeals in recent months, running an agent or broker on an average of $39,000 in typical losing case.
Whoa! So they're losing cases.
That's 13% higher than it was in 2021.
Did you say
the
average?
Housing market? Yeah, that's an average of $39,000 in a typical losing case.
Wow.
The housing market has since come down off its roaring highs. That peak spurred by historically low. Yep, we've already talked about all that stuff. And buyers, in their desperation to land a home, often waived protective contingencies.
Wow.
In some of these cases, buyers sue their agent or broker. The buyer waived their inspection contingency and later discovered an issue with the property. Quote, people are already thinking they overpay the house and then the water heater breaks and they start renovating the basement and they find mold. Attorney Matt Aligi told the publication they're having buyer's remorse. They're upset and they want someone to pay.
Well, and I'm assuming that part of their upsettedness, that's a word I just invented. I'm assuming that comes from they probably feel like they overpaid. It's probably not in the exact location. It's probably not the 10 out of 10 they wanted. It probably does not check off all the boxes they wanted. And then they found mold. And then they figured out, when they pulled out the refrigerator because they had to buy a new fridge because the one that they bought with the house broke, they were like,
Here's a quote from this attorney, Alegi, Alegi.
Oh, sorry, I haven't done this yet. Sorry.
Yeah, we haven't quoted him today. Agents need to be clear with their clients that not having an inspection contingency is different than not having an inspection. Inspections don't blow up deals unless there's something really, really wrong.
That is a fair point. You can still have your inspection done, but yeah. So
sometimes.
But if you don't have a contingency
in Arkansas,
in place, though, I don't know how it is across the country, but for here, if you don't have a contingency, it's not part of the contract that you can say, well, wait, I found mold. I want you guys to fix that, or I get to cancel without penalty. So you still do your inspection, but
that's what we had too. So you can do an inspection, but you basically, if you buy it as is according to the contract, you cannot. But there's a way that we say, hey, we're going to do an inspection, but we don't expect any seller repairs. So the buyer is buying this. They don't want any seller repairs. But they are going to inspect and approve that inspection before they move forward.
Yeah.
For us, it's one of the contingencies.
It's one of the
So we do have a contingency period.
Yeah.
But if you buy a house without a contingency on the inspection, you can still inspect, but you can't get out of the deal.
Yeah, you can't cancel because of the property condition.
I don't know that attorney is fully informed, but
so ours is like a due diligence period. So that's when you're doing title searches. You know, if you want to add on, you can during that period, which is 17 days, unless you shorten it. If you wanted to go out to, you know, I wanted to add on to this house. So you go down to City Hall and pull the records and see if you can add it onto the house. Can you do what you want? You can do all that stuff. That's all part of that. And there's technically different removals for all that, but it's all under the inspection contingency, which is due diligence, your period of discovery, so to speak.
Yeah. So I guess to throw it back to an old NFL commercial that was fantastic. You be the judge. You remember those commercials? Those were great.
Yeah.
They would show like something happening and say, you be the judge. And then they'd have 2 or 3 more commercials and they'd come back and tell you if you were wrong or right. Those were great.
I think that's
where our thumbnail comes from. Well, kind of. Our thumbnail does come from the courtroom because we're talking about agents being dragged into court. There it is. So it's from the movie The Judge. I was gonna put Dan as the judge, but his hair is too tall, so you wouldn't get the benefit of seeing his hair there.
Yeah,
so
you got to see my hair. It's just dumb. But
I don't have any, so it didn't make.
It doesn't matter.
Just assume. Right? You could assume what the finish line looks like if you start here.
Yeah.
Well, Dan, that's all we got for today. We do want some feedback on the show. So if you like this week and last week and how we did it, highlighting all the main headlines at the front of the show and then having a deep dive later on in the show, we would love some feedback on what you thought. So you could just drop us a line on the Instagrams. Mine is Ray Zorback, RayZorback. Dan, where can they find you?
DLUD. If you want to see why I went viral, I'm just kidding. DLUDWIGROCKS. It's the same on YouTube as well. Just D Let It Rocks. I have more videos in the can, but I haven't posted them yet. But I have one up there, a good one. Go watch that. And then on Instagram, DLUDWIGROCKS.
Nice. Thanks everybody for watching. Thank you for all the comments. We will see you guys next week.
Check on your friends. Tell them you love them. Bye.